All right, welcome to Private Infrastructure Due Diligence. Mr. Mash here, I hope you're doing well. Due diligence with regards to private infrastructure involves the complexity and longevity of these types of investments. Infrastructure assets, they require sector-specific legal and technical expertise for due diligence. And also, there's an emphasis of the long-term viability over multiple cycles, considering things like the jurisdiction, legal, and performance risks. There are three main areas to consider with regards to due diligence in infrastructure. So we're going to consider three key areas of due diligence. One is the jurisdiction, legal, and regulatory framework. When you do the due diligence for infrastructure investments, you're going to analyze the host country's laws, property rights, concession terms, and sovereign immunity. And also, you would want to evaluate how disputes have been resolved. You can look at how they've handled cases in the past. When an investor had a dispute, how did the courts deal with that issue? Because if you're not careful, especially in developing economies that have very weak institutions, you're going to lose a lot of money. A big politician who has connections to the political elite will take over your business like it's nothing. So you need to see if the laws in that country are being respected or they are being regarded. And also you want to look at how there is financial recourse, anti-corruption compliance. And so this whole goes to the institutions of the country in which you would want to invest in. And also you would consider support from global institutions in developing markets. The World Bank is very popular for trying to reduce poverty through investments in things like infrastructure, mostly in developing countries. It was actually developed, the World Bank was actually initiated soon after World War II to help with infrastructure development. So now they help a lot of developing economies with infrastructure developments, with funding for such projects. So you look at all of those things when you consider the jurisdiction, the legal, and the regulatory framework. Two is the EPC, engineering, procurement, and construction. So you want to ensure that whatever project you want to undertake is technically feasible, it's safe, and it adheres to the standards that are within the framework of the country you want to work in. Also, you want to assess the costs, the timelines, and risks of overruns or delays, and review procurement strategy, contracts, and contractor credibility. So that's two. So two is EPC, engineering, procurement, and construction. And then the third key area of due diligence in infrastructure investments is concession scope and specifications and term. So you analyze revenue flows, maintenance requirements, and end of term obligations. Is this project going to end with a finite life, or is it going to perpetuate, or is it going to be transferred to the public sector? You consider all of those things. And then you also address payment contingencies tied to performance or upgrades. So these are the three main areas of due diligence in private infrastructure investments: jurisdiction, legal, and regulatory framework, engineering, procurement, and construction, EPC, and concession scope, specifications, and term. All right, so we also want to look at the macroeconomic framework, the macroeconomic and market review outlook. In this instance, we spoke about this jurisdictional, legal, and regulatory framework. There's also property and project plan review, EPC, engineering, procurement, and construction issues, insurance, redress, and risk mitigation, how they've handled any issues in the past. Anyone who was aggrieved, are the institutions strong enough to be non-partisan or to be impartial? That's the word I was looking for. ESG considerations, also this is very important in any investment. Partnerships, special purpose vehicles, and documentation review. You look at the concession specifications, the scope, and the term. Then you consider the relationship between the concession grantor and the concessionaire, how the concession grantor has worked in the past, if there's any risk of default, and also the concessionaire's performance and default risk. You consider these things, and then the revenue, expenses, cash flows, projections, and the financing plan. The financing plan considers both the debt and the equity. And remember, in this instance, when you look at the debt, you want to look at the cost of leverage. When you look at the equity, you want to consider the risks of refinancing at some later stage so that you don't lose out on your entire investment. So these are elements of infrastructure investment due diligence. All right. So it's not much, but you need to understand these frameworks and the theory behind this. We are going to do a few exercises, but before we do exercises on due diligence, it's also important to understand the valuation of infrastructure assets. And we are going to be valuing infrastructure assets using the expected dividends or cash flow method. So we are going to use the discounted cash flow method, where we calculate the present value of an asset by considering expected future cash flows. Okay, so the intrinsic value is just the sum of expected future cash flows, which are discounted at a risk-free rate plus a risk premium, which basically means that we are going to be using a build-up approach, where on top of the risk-free rate, we are going to add asset-specific risk premiums based on the size, the location, the leverage, the profitability, the nature of the investment, and so forth. There are many aspects that are considered when determining the risk premium, and these are going to depend on the nature of the product. Remember, we said infrastructure investments are unique. So each unique product is going to have its unique risk premiums based on these aspects, not limited to this. There are quite a lot, but they will depend on the type of project that you're dealing with. So on top of the risk-free rate, this is the risk-free, you add other premiums. Okay, so we opted for the discounted cash flow approach because there are limited comparable transactions in infrastructure. The projects are unique. We said these projects are heterogeneous. They're heterogeneous, and in most instances, they are not going to have comparables. There are no comparables. So which is why we are going to use the discounted cash flow method. And also, they capture a project's cash flows and life cycle dynamics effectively. You need to know these things because they usually come out in the vineyard style questions where they list these things, and you have to be able to determine whether a statement is true or not. The reasons why we do not choose the alternatives, for instance, relative valuation, we do not take the relative valuation because of a scarcity of comparables. We do not have comparables with infrastructure investments. We have unique investments. And a replacement cost approach, we do not use that because the replacement cost approach overlooks the business model, cash flow sources, and project life cycle. So you also need to understand these limitations. With the relative valuation, there are no comparables. With replacement cost, it overlooks the business model, cash flow sources, and project life cycle. All right. So basically, as I mentioned earlier, this here is the risk factors, the risk premium that is added to the risk-free rate is just a summation. You just add all of them up. So there's nothing complicated. It's very simple. You'll see when you do an example now. Very straightforward. You add the different risk premiums. The size, if it's large, it's a higher premium, so you add. The bigger the project, the higher the risk. So they add a higher premium. Leverage, more debt, higher risk, so you add the premium. Profitability, this is inversely related to risk, which basically means, so this is intuitive, right? If you think that a project is going to be profitable, it means the risk premium has to be low. So it has lower risk because it's likely to make you money. Investment, the bigger the investment, the higher the risk, especially with greenfield investments. Remember, these are new. Greenfield investments, they are new. When we did the risk return profile for risk return, so I'm quickly going through these things because there are things that I think if you read, you understand. There's nothing complicated. We had our core investments here. We had our core plus here. And then after core plus, we had value add. And then at the very top, we had opportunistic, right? And we said with our core, these are secondary assets which are existing ones with already a source of income, hence they have low risk, low return. And then here we have secondary assets are there, but you also have brownfield investments, and with value add you have brownfield and possibly greenfield as well. But at the very top here you have the greenfield, and the greenfield investments are the new ones, which are very risky. High risk, this greenfield, high risk, high return. Country risk, developing markets, goes without saying, quite risky, mostly with political risk, a lot of uncertainty there. Currency risk, if a currency is not hedged, it means they are susceptible to changes in the market and anything can happen. So an unhedged currency carries a higher risk premium. Okay, so basically these are some of the premiums that are considered when we are using the build-up approach. They'll give you the premiums so that you know which premium you're going to be adding for a particular project. Because the projects are unique, they have different risk premiums, but you add these risk premiums or subtract them from the risk-free rate. We are going to do this example, right? This example from your curriculum has so much information there. Looking at it will give you a headache. But dealing with this question is as easy as ABC. It's not really complicated. You will see just now when you go through it. It's really not difficult. Read through the question. Try to think about it. The information I've given you here is all the information you're going to need. I just isolated the information you need to be able to answer this question. So read the question and think about it and see how you can maybe fill in 4, 5, and then 13, 14 based on the information given. Let me just highlight important things here. Meg Zhu is an analyst, right? And she is considering investing in Taipei Airport project. She notes the expected 200 million in initial operating year 4 revenue. So the revenue comes from the number of passengers and the amount of money that they pay per passenger. So 5 million times 20 gives you 12, times 40 gives you 200 million, right? Based on her analysis of expected Vietnamese economic growth and existing airport cost structures, Zhu formulates the following assumptions to project future cash flows. For the first 10 years of operation through year 13, TBA passenger traffic grows by 5% annually, while revenue per passenger rises 1% per year. So you want to increase the number of passengers by 5% and the revenue, that 40, by 1%, which means basically from year 4 all the way up to year 13 for 10 years, you're going to take the revenue. Let's say you're in year 4 here, this 200,000 is given, you put it here. To get this value and the values that follow, what I did is I just saved. Remember, in your financial calculator you can store a number. I took this growth rate of 5% on the passengers, and then I multiplied this by the growth rate in the revenue, and then I got, let me just record this. I think I still have it saved. Yes, 1.0605. This is the number that I stored in my key one, and then I just said recall key one, and then we multiply by 200 million. You get an answer. The answer you get there, this is going to be year 5. with year 6, you just say the answer you got here, you multiply again by this. And then that's how you get the 6th one. And then it continues like that. So this answer is just 1.065 multiplied by 200 million. That's how you get 212,100,000. All right. And then to get the operation, the net cash flow from operations, net operating income, they tell you that starting in the 11th year of operation, year 14 through the end of concession period. So from year 14 here, the respective growth rate falls by 50%. I'm going to come back to this one. I wanted to explain this net operating income. You estimate operating and other expenses equal to 50% of revenue and assume a tax rate of 20%. So your operating expenses are 50%, which means if you take away 50%, you're going to be left with 50%. So half. So all of these numbers are half of this. Just try it. Half of 200 million, it's 100 million. Half of 212 million, it's 106 million, and so forth. Okay, and yeah, just half, 50% of this. The debt service, you simply add up the debt service for all the different types of debts that the company took. There are 4 of them. There is this senior debt, the senior loan, the bank loan, and another junior debt. The reason I didn't include the junior debt here is because the debt service was 0 up until the 13th year, year number 13. So you just add this, the debt service here, 9,540,000 debt service, plus 17,625,000 plus this 6,500,000 plus the junior debt. If you add all of these, they must give you a debt service of 33,665,000, which is the answer they get here. So for all of them, you just look at the debt structure and then you add the debt services given. The debt service is given. You just add these values. That's how you get all of these debt values, right? You can put all these numbers in Excel. It makes life easier. Then the before tax cash flow, you simply subtract. Remember, the before tax cash flow is given by the net operating income minus the debt service. So you just take the 100 million, you subtract the 33,665,000. You must get 66,335,000. The tax, it's a 20% of this, right? So 20% of this is 13,267,000. And then the after tax dividend, it's just the before tax cash flow minus the tax. And then you get 53,068,000. Alternatively, you just take the 66 million and you multiply by 0.8. It's something that I'm sure you know how to do. All right. Another important thing, I said I'll come back here. Year 14, the end of the concession period, the respective growth rates fall by 50%. So this 5% falls by 50%, and this 1% falls by 50%. What you're going to do is to reduce this growth rate by 50% such that your growth rate is going to be, if you reduce them by 50% from year, let me say G2, the second growth rate, is going to be equal to 1.030125. So you multiply all your values by this amount, which means for year 14, you're going to take this amount, the 339 million, this one, 332,965, and then you multiply it by this 1.030125. That's how you get this amount. In the curriculum, because this example is from the curriculum, right? This amount, they made a mistake here. They said 3.515 is not correct. This is the correct growth rate. And then that's the one you multiply all the revenues that come after 13, from 14 up until 20. You multiply by 1.30125. So that's something that you must take note of from year 14 so that you don't get confused. Let's go to the next question. Contrast the risks of the senior loan A and the junior debt tranches in the context of TBA's debt profile and project phases. Okay, so think about it. Look at these loans. This is a simple question in the sense that you are simply comparing the different loans. In what year is the senior loan drawn down? In what year is the junior loan drawn down? In what year do they start to pay back the money for the senior loan? So this is the drawdown year for the senior loan. This is the drawdown year for the junior loan. The payments of the debt, they start paying them in what year for the junior loan, and in what year do they pay for the senior loan? So you will see the interest and principal paid is from year 4 here, and then year 7 for the senior loan. But for the junior loan, goes way down here. The interest paid, it's actually year, can't see now, 14, 15, down somewhere there. And also the principal paid, it's down here, year 14. Okay, so you are simply explaining things that you're actually observing. Okay, so you have two loans. Loan A is senior, so this is a senior loan, and then the junior debt is a junior loan, so this is the junior debt. This junior debt is more risky. It's more risky because it's lower in priority. It comes after the senior, so it's lower in terms of priority. Okay, the junior debt is drawn earlier in year 0. You see, you state this, that junior debt drawn earlier. So junior debt drawn earlier. You mentioned this, but don't over explain these things. Even if you write them in point form, the CFA accepts that drawn earlier, which is year 0, and the junior debt is going to remain fully outstanding during the construction and development. So this junior debt remains outstanding during the construction and development. In terms of repayment, you look at the repayment schedule now, and you note that the junior debt, like I mentioned, they start to repay the junior debt down here from year 14 all the way up to year 17. And then the senior debt, it's paid earlier from year 7 up until year 10, which basically means that in terms of subordination claim, the junior debt comes after. You see, it's being paid from year 14. So it's a lower subordination as opposed to the senior debt. It's only going to be, the junior debt is only going to be repaid after the senior debt. The junior debt is actually coming last, because there's this senior loan and there are other more senior loans before we come to the junior debt. This is actually the last one in terms of priority of payment. Okay, and you see that the payment for the junior debt is actually being paid when cash flows have now become stable. There's a stability in cash flows. Remember, the money has been coming in for some time. By the time we get to year 13, the revenue is now stable, right? And the company is now going through a mature phase, and the growth rate in terms of 50%, in terms of that 5% of this was the growth in passengers, and also 50% of the 1% of the revenue. So the revenue is stabilized and it's lower. That's when they now start to pay the junior debt. The growth of revenue is lower. The revenue is still growing, but at a lower rate. Remember the company life cycle where the revenue starts to grow and then it starts to stabilize. It's now at this point of maturity. Okay, so you're comparing these two debts with what you are seeing there. So I put the information that you need in this slide. Let's go to the third question. You are given, you are asked to discuss the project period or periods in which TBA is at greatest risk of being unable to meet its debt service. So in this instance, you use the debt service coverage ratio, which is the net operating income divided by the debt service. All of these numbers, you have them. We calculated our net operating income, we calculated our debt service by adding all those different debt structures. We divide this, and these are the debt service coverage ratios that we get. What you just want to look at is at what periods do we have the lower debt service coverage, and at what periods do we have the higher debt service coverage. So looking at this, we see that, remember, the debt service just measures the ability to meet our debt obligations, right? Which means when it becomes too low, we might be in danger of not meeting our debt obligations, because the money coming in is lower as compared to the debt. But still, in all cases, our debt service is more than 1, which means the net income is higher than the debt service, which is a good thing. All right. So you will see here the debt service is lowest in year 7 here. This is where the debt service is. This is the lowest. Okay. And you realize that in year 7, this is actually when loan A starts to be amortized. So loan A starts to be amortized. Amortization of loan A. Okay, so that's the lowest. Let's go up. Let's see. Loan A, year 7. You see, this is the year in which loan A starts to be amortized, and that's the year in which we have the lowest debt service coverage ratio. And then this debt service ratio actually remains above 2 from these years, from year 4 to year 7. Here in year 4 to year 7, this debt service coverage ratio is above 2, which is actually a good thing. And when the bank loans are being paid off from years 13 to years 17, the debt service coverage are below 2 here. So here the debt service are going to be below 2, which is not necessarily a bad thing, because remember, in this instance, the bank loans are being paid here. They are paying the bank loan, so this bank ECA loan, and they are paying the junior loan. They are paying the junior loan, and these are being paid between years 13 to years 17, which explains these lower debt service coverage ratios. This means in this instance, there's a higher risk of them not being able to pay. That's where the greatest risk is, when the debt service is lowest. That's where the greatest risk is, because of very high debt obligations. They're very debt high obligations. Most of the debt are being amortized. They've 4 of them, and this bank ECA and the junior loan are being amortized, and they are paying back this debt. All right. In years 11 and 12, in this instance, these are actually very high. These are very high. And in years 11 and 12, one of the loans has been fully paid. Okay, the Term A senior loan was fully paid by year 10, which actually increased the debt service here. We have a lot of income as compared to debt. This might not be necessarily a good thing all the time, because this is quite high. It might reflect that you're not efficiently using the income that you have, but it's expected because the senior debt loan A has been paid off, hence this high. It drops now because of the other loan obligations that you've started paying off. So basically, that's how you would explain this using the debt service coverage. All right, let's go to another question now, where we deal with the valuation using the discounted cash flow method. So you can pause the video understand the question and see what you need here. The question wants you to calculate the respective annual discount rates for Tayberg Airport project concession period based on use research. So this here is the risk-free rate for these years, and this is use research. To calculate the discount rates is straightforward because you just take the risk-free rate and then you add the premiums. So we are going to add the size. As a regional airport considers Tayberg in a mid-size project which warrants a 1.5 risk premium, you add this. Leverage, highest 2.5 premium. EC Bank 1.5 premium and 0.5 leverage, so 0 thereafter. So you have these different premiums assigned to the leverage with different types of debts. Profitability is expected to have median profitability and relatively low investment levels once construction is completed in the first 3 years. So we are going to have this -0 as the risk premium and then adjusted 0.5 risk premium adjusted respectively. We put these here, the size 1.5, the leverage 2.5, profitability is -1%, then adjusted by 0.5, okay, and then we adjust, we simply then add all of this, the risk-free rate plus the size plus the leverage minus the profitability plus investment plus the country and currency risk. This is very high. It's here. Country and currency risk based on Vietnam's status as a thriving middle income economy and positive outlook. You estimates the country risk of Vietnam to be constant 4% throughout the concession period. Given the project cash flows primarily in Vietnamese VND, while financing it's denominated in US dollars and the currency risk is unhedged, Joe increases the risk premium by 1% based on the potential future of VND depreciation. So the Vietnamese dong, she then adds this country's risk premium 4% plus, because the currency is unhedged, she adds a 1%, which is where this high 5% comes from. You just add these, that's how they get these values at the end. Also, very straightforward, right? Just make sure you read through this carefully. They will give you these premiums. You just have to add them using this build-up approach. Using the build-up approach, okay. Okay, you just add them, and that's it. And let's go to the next part. I'm sure you can do this. Go to the next one. Solve the expected Tayberg Airport project value at the end of year 3. So you want the value of the airport at the end of year 3, which is here. And remember, with this method, you want the value at the end of year 3. This is year 3. So we are going to discount going into the future from year 4, 5, 6, up until you get to year 23. You want to discount these cash flows, all of them. You want to discount all of them to this particular point here. This is where you want the value to be. Okay. And we said to get this intrinsic value, we just have to get the sum of the discounted cash flows. Okay, we're just going to sum up from I equals 1 to the last time period of the cash flow I, and then we divide the cash flows by the discount factor, which is 1 plus R plus the premium, and then this is to the power of a T minus 3. Okay, and remember the T is starting from 4, which is why we say minus 3, so that we can have a 1 here, a 2 there, a 3 there, a 4 there, a 5 there, and it continues like that. Okay, so let's look at this discount factor. These are the adjusted rates, right? You're just going to say 1 divided by 11 is just 1 over 1.11. 0.11596 to the power of 4 minus 3, it's 1. You must get 0.89609. Then the second one, this one here, 1 divided by 1,11704. This is equals to 0.80142. That's how you calculate the discount factor. That's pretty straightforward, right? Once you get this, remember this is squared, and it goes on and on and on until the last one. 1 to the power 1 to the power 2 to the power 3, it goes on. That's how you get all these discount factors, right? And then you multiply the discount factor times the after-tax dividend. 0.89 times 53, you multiply these two, you get this present value cash flow. And then 0.8 times 48, you get this. So you simply multiply the discount factor. You can try any of them, put them in Excel. 0.27 times 31, you get this 8 million, and so forth. And then the final value now is the summation of all of these. You add all of them for you to get now the value of the project at year 3. If you add all of them, you must get an answer of 460,642,367 Vietnamese dong. That becomes the answer for this particular project. Okay, it's actually dollars. I'm not sure. Just confirm the currency. Dollars. Is it dong? Vietnamese dollars. Project, I'm sure it was in dollars. Anyway, what's important is if you add all of them, you must get this. It's just summing up all of these values here. Discuss the return to equity holders over the transaction period. So I put the equity investment here because we are talking about equity holders. You want to look at the equity holders, the money they invested, and the value that they expect at the end of the project, the tenure of the project, and you want to calculate the return as the interest, the internal rate of return. So you're going to use your financial calculator for this. Think about it, and let's do it together. You can pause, give it a try, then we do it together. We have the present value. The number you're going to put in your calculator as your present value is this amount that you invested minus 315 million. The future value is this value here that we calculated from year 1 to year 3, which is 460 million 642,367. There are no periodic payments, so this is 0. And then n, the number of years over the construction period, is 3 years. To get the return, you're going to compute the internal rate of return. It is the interest. And this is going to be equal to 13.51%. Okay, so this is the return, which is quite high for the equity holders based on the cash flows, the money they invested, what they expect to get, the construction period of 3 years without any periodic payments going to them or to the project, and the future value of 460. Okay, so that's the answer we get there. Now, it's your time to shine. It is your time to shine. It's your time to shine. I want you to go through these questions, homework questions. You read through this, pause, and try and explain. Discuss how changes in growth expectations in her sensitivity analysis might cause you to revisit your assumptions affecting the numerator of the infrastructure valuation. So look at the sensitivity analysis and try and think how her expectations could affect the numerator, the cash flows. The next question, you also look at the sensitivity analysis, but now you want to look at how your assumptions are going to affect the denominator, the risk premiums. Then the last question, you're going to discuss how changes in inflation may affect the valuation of Tayberg Airport project. It's these three questions based on this case study, right? So you're just evaluating. You're not even calculating anything. You're just looking at the discounted cash flow method, how the numerator is affected by sensitivity analysis, how the denominator is affected, and how inflation affects the valuation of a project. Okay, so that's not it. Do not despair. We have more. So also try this question where you have to do a bit of calculations here, where you demonstrate the effect of a 10% cost overrun. You demonstrate the effect of a 1-year delay. So you pause this and you read through carefully and you attempt. And also, you evaluate the 1-year delay scenario if debt cash flows are not delayed, and also justify the pattern of declining discount factors used to determine TBA project value. All right. So these are the homework questions. It's quite a bit. Just take your time, understand what you're doing, give it a try. When I see you guys in the next section, we'll be going through these questions. After which, we wrap up this entire series by looking at the risk and return profile of private invest infrastructure in the context of strategic asset allocation. All right, I can't wait. I'll see you guys in the next one. For now, Mr. Mash is out. Enjoy your homework. Cheers.